We're very happy to host Equinox Gold. We have Greg Smith, the CEO and director. I own almost 100,000 shares of Equinox. I'm so impressed that they built the Greenstone mine for 1.23 billion, or about 60% less than Cote Lake, and they're very similar mines. And I'm very interested in the potential turnaround to improve the costs in Brazil and Mexico. Without further ado, Greg, tell us the story, please.
Thanks, John. Appreciate it. Again, my name is Greg Smith. I'm the CEO of Equinox Gold, and I have been since September of 2022. Before that, I was president of the company and have been involved in one way or another since 2016. So just to go back in time, well, let me back up. I will be making some cautionary statements. If anyone wants to review these, there on our website in any of the presentation decks that are on there. So, going back in time here, really it's only been about 6 or 7 years since we formed Equinox. We originally started this company in 2017 through a three-way merger with a company that Ross Beatty was running, a company that Richard Wark was running, and another company that I was involved with that had the Aurizona asset in Brazil. And we merged those three companies, created Equinox Gold. Ross Beatty, many of you probably will have heard of him. He is a very well-known mining investor, billionaire, philanthropist, sort of serially successful guy. Just got the Lifetime Achievement Award from the Northern Miner that he just received in London. On our website, on YouTube, you can find plenty of interviews of Ross and talking about all sorts of things, including Equinox, including the gold market. So very good source of information on our company right from the chairman. Anyway, he in 2017, late 2017, became our largest shareholder, individual shareholder, and our chairman. And his very first public company was called Equinox Resources. As he said himself, Equinox Gold is his last public company. And he really had a vision to build Equinox into a significant, large, profitable gold company here in Vancouver that ultimately can pay dividends to his foundation long after he's gone. So that's kind of the vision that we've been operating under as we've been building this company. And you can see here that since 2018, we had our first production in 2018. That was from our Mesquite mine in California that we acquired in October of 2018. And then since that time, we've been building up a progressively larger production profile. We've acquired some additional companies. We've built some additional mines. We've also sold a couple of mines. We've created some new companies, including Solaris Resources, a company originally called Sandbox Royalties, now called Versamet Royalties, and also participated in the creation of I-80 Gold when it was spun out of Premier. Today, 2024, big year for us. We completed the construction of our Greenstone mine largely by the end of 2023. And 2024, the focus has been on bringing Greenstone into production. As John mentioned, we acquired the rest of Greenstone that we didn't already own. It had previously been a joint venture with Orion Mine Finance. We acquired the remaining 40% of the mine in the second quarter. And so now we own 100% of Greenstone. This year, our production, including the initial production from Greenstone, will be in that 630,000 ounces range. So again, where are we today after sort of a period of time here of building the company? We've got 7 producing mines, 3 expansion projects. This is all in the Americas, Greenstone in Canada. In the United States, we have our Mesquite mine and our Castle Mountain development project, the Los Filos mine in Mexico, and then a portfolio of mines in Brazil. Very large reserve base at Equinox Gold, 19 million ounces, large resource base of 17 million additional ounces. that excludes additional inferred ounces. That's just M&I. And our broad goal, our vision has been to achieve 1 million ounces of annual gold production. Again, I'll caveat that by saying there's nothing special to 1 million ounces in and of itself, whether it's 900,000 or 1.1 million, whatever the case is. It's more of an indicator of scale. At that scale, you're in a position where you can still make meaningful advancements in your projects and in your production profile. You're large enough that you're included in various indices. You've got a lower cost of capital, more access to capital. You're in a better position to acquire pipeline assets, and you've got larger liquidity. It just makes you a more investable company. So really more of an indicator of scale from our perspective. Our board of directors, I won't dwell on this too long. I already mentioned Ross Beatty. We've got a good group of people here involved in Equinox, and everybody here is a shareholder. Everybody here is keen on growing this company. And we talk about alignment here. Again, Ross is our largest individual shareholder. When we acquired the rest of Greenstone this year, we issued some equity to do that, so it brought down his overall interest a little bit from around 8.6 to 6.6. Still is our largest shareholder. Of all the mid-tier gold companies, save Endeavour Mining, we have the largest inside ownership. Every executive, certainly the C-suite and all of our senior executives are shareholders in the company. For the most part, we bought our shares. I've been invested in this company one way or another for probably 10 years plus in predecessor companies. And most of our staff do participate in a stock purchase program at the company. And I would even say that extends down to our mine country managers, mine managers as well. Shareholder base, primarily the United States, Canada, and Europe, with some shareholders throughout the rest of the world. So 2024 guidance now, midpoint is about 630,000 ounces of gold, primarily coming from our Los Filos mine, our Aurizona mine in Brazil, our Greenstone mine in Canada, and then when we say the Bahia complex, this is a combination of our Santa Luz and Fazenda mines. I'll talk about that a little later in the presentation, but we are working on a merger of those two assets into one production complex. Then we also have production coming from our Mesquite mine, our RDM mine also in Brazil, and then a minor amount from what we call our Castle Mountain Phase 1 mine. Cash costs this year between $1,450 and $1,550. All-in sustaining costs, $1,820 to $1,920. A little high in 2024 for a couple of reasons, primarily a lower denominator at some of our mines, including Mesquite and Aurizona, and a fairly high cost year at Los Filos. Good production at Los Filos, but higher cost ounces. So the big news in 2024 has been our Greenstone mine. And we acquired this project back in 2021 is when we closed it. We announced the transaction in late 2020, which was the acquisition of Premier Gold. This brought us a portfolio of assets that included a 50% interest in the Greenstone mine. And the reason that we were so interested in this transaction is because a project like Greenstone, a mine like Greenstone, actually at the time, just a deposit like Greenstone, of that scale, of that grade, in that location, with a permit, with a great team, with a substantial amount of engineering already complete in anticipation of a construction decision, that kind of opportunity is extremely rare. And the way we looked at the transaction with Premier was we can buy Premier, and if we take all the assets from Premier, which included our Hasaga assets in Red Lake, the Mercedes mine in Mexico, an equity interest in i-80 Gold, some cash, etc. Once we monetized most of those additional assets, we were going to get our interest in Greenstone for a very nominal value. So that was very attractive to us. We also were aware that Orion was looking to buy the other 50%, and Orion Mine Finance, it's a private equity firm, based in New York and in London. They're great guys. We've worked with them before, so we were very keen to have them as our partner as well. And they were willing to sell us an additional 10% to bring our interest to 60%. So through a series of transactions that happened between late 2020 and March 2021, we were able to acquire Premier Gold and then increase our interest in the Greenstone mine to 60%, with Orion as our joint venture at 40%. And then, also ended up with a portfolio of other assets that over time we've surfaced value from, and some will surface value from in the future. Again, very rare to find an asset of this quality that is not already held by a major, and already had permits, which is a very unusual situation. The mine can produce, it varies by year, but over the first 5 years on average, it's about 390,000 ounces of gold per year. It's got a 15-year mine life in the open pit reserves only. We see some expansion potential there. We'll talk a bit about that. And then, average grade, 1.23 grams per ton life of mine, very attractive average grade for a deposit of this scale, 5.7 million ounces in reserves, and another 2.2 in additional M&I resources. In terms of the location of Greenstone, basically you fly to Thunder Bay. It's in Northern Ontario, fairly large city, 3 hours on the Trans-Canada Highway, and you're at this mine. It's right on the highway. In fact, we had to move the highway to build it. It's within 14 kilometers of the Trans-Canada natural gas pipeline, and Enbridge built us a connector, so we have a fully natural gas-fired power plant off the main line in Canada. And so you've got natural gas, you've got highway access, you have electrical power that was coming from the town of Geraldton that we used for the build. And then with the municipality of Greenstone and the town of Geraldton and the surrounding communities, you've got a large percentage of your workforce local to the project, which is also saves money and is a real benefit for the employees of the mine. Just some context here. Greenstone is one of Canada's largest gold mines. It's certainly one of Canada's highest grade open pit gold mines. Again, there's only a handful of mines really in the world that can produce at this level that are not already owned by a major. When you look at this chart, you look at Detour Lake, you look at Malartic, you look at Meadowbank, those are all owned by Agnico Eagle. So is Meliadine. The ones that are not owned by majors right now, it's Greenstone, it's Côté, it's Blackwater, but then you get into Brucejack, owned by Newmont, LaRonde, Agnico. Island is Alamos Gold. Macassa is, I believe, Pan American Silver. So again, not a whole lot of assets like this that are owned in the intermediate gold space. And in terms of cost, I mean, this chart is sort of all-encompassing gold mines around the world type of thing. Greenstone will fall in the lowest quartile of costs, and we're already seeing that. You can see in our financial results to date, and you'll see that as we go into 2025. Very, very attractive operating costs at Greenstone. In particular, right now with the fairly weak US dollar, it does benefit cost structure at Greenstone. So again, we put first ore into our crusher at Greenstone in April. We had the first gold pour at Greenstone in May. In Q2, we produced 16,000 ounces of gold, just over. Q3, we produced just over 42,000 ounces of gold. We're going to produce substantially more again here in Q4, and basically are just systematically ramping up both the mining rates and also the mill throughput. So we had 125,000 tons per day mining in September, move that up to 145,000 tons per day in October. We're going to probably sit at around that level through the end of the year. Then we have another 4 trucks coming in early next year. Eventually, we'll ramp up to 190,000 tons per day when we get to full capacity. This year, 2024, a little bit of a complex year in terms of opening up the open pit. This region did have historic mining, and part of our footprint of the open pit had previous mines on it, as well as some tailings impoundments that were on that on top of the deposit. Part of our permit was to remove contaminated soils from that area, remove tailings from that area, and we also use clean waste from the open pit in constructing our tailings facility. So you had competing demands on the mining fleet outside of just ore delivery and opening up that pit. We had to get the contaminated soils removed before we could even mine in certain areas of the open pit. And this isn't a great picture, but if you look at the pit, which is in the top right here of the photo, you can see kind of a small initial pit there. And that was, that's for ore and waste to deliver feed to the mill. And then we've got a big area where we haven't really mined at all. We called that the island, and that's where the contaminated soils were. So it just, all that is to say, a bit complicated mining during 2024. We've now removed all those contaminated soils. We've moved all the tailings we were planning to move in the near term here. And the focus now is opening up that pit, giving us longer, wider benches so we can do larger and fewer blasts, have more broken ore stocks in pit, and then be more efficient at moving ore to the plant, waste to the waste dumps. What you'll see as a result of that is our already attractive mining costs will go down, and our mining rates will increase. It's just more efficient. And then in the mill,
the mill, 27,000 tons a day, is that right?
So the mine plan and the processing plan calls for 27,000 tons per day through the mill, and so, but it's designed to do 30,000 plus.
Is the waste stripping higher in the early years, which is why you'd have 190,000 ton a day rock movement? That feels like a high strip.
You have an initial, there's a couple of things that play there. Yes, I mean, as you pioneer the open pit, you do have a higher strip. The other aspect to it, though, is that this mine delivered, and also we have the use of clean material, waste from the open pit to build the tailings facility. So, and also to the expansion of the tailings facility. So we use a lot of that material in construction of the tailings dam. And then the other side of it is this mine actually does produce more ore than the plant has capacity for. And the way we manage production is we've got a bin method of stockpiling. So, higher grade tons go directly into the mill, lower grade stockpile tons go into the various stockpile bins. And over the course of the mine life, you have periods where the strip ratio increases or decreases, and you can fill the mill with stockpile material. Of course, the lowest grade will go in at the end of the mine life. So you do produce more ore tons than the throughput, and to some extent you stockpile them, and then they help mitigate any changes in that strip ratio over time when you're in a period of moving more waste than ore.
Thank you for the explanation.
Yeah, no problem. And then on the milling side, so again, it's pretty conventional CIP plant. We've got a two-stage crush. It then goes into what's called an HPGR. It's a high-pressure grinding roll system. These are, 10 years ago, these were kind of unique. Now they seem to be popping up everywhere. Our mine, Cote, I know El Dorado put one in at Kisladog as well. What these are is they're just high-pressure, giant steel rollers that break ore between the rollers. You get good fraction of the material through that methodology. But the big win with an HPGR is it replaces a SAG mill and it draws a lot less power. And it's a piece of equipment that, frankly, we were less familiar with. We did a lot of work once we bought Premier to sort of verify that this made the most sense to use. Since we've gone into production, it's been one of the best performing pieces of equipment. It's been fantastic. So very happy with the HPGR. HPGR then sends material into two parallel ball mills, and then from there they go into the carbon and pulp leaching circuit to produce gold. The mill itself, as John mentioned, is 27,000 tons per day is the planned throughput. We've exceeded that many, many times and demonstrated that the mill can produce or process substantially more material than 27,000 tons per day. But it's a process of ramping up. So as you ramp up a big system like this, you find pressure points or transfer points where perhaps it's not as designed as well as it could be, or you're getting wear parts that are wearing faster than you'd like, or you've got other areas of where bottlenecks are manifesting that you need to deal with. we found at Greenstone, when we started up, we were really ambitious and optimistic at hitting our planned throughputs quite quickly. Things were going really, really well at the beginning, and that was a testament to the capacity of the circuit to process the planned tonnage. It had no problem with that. But then we had a few things we had to deal with. In the summer, we had to deal with one of the ball mill motors. It was, this is a warranty issue. We had to deal with some issues with the screen decks, again, a warranty issue. As we came into the fall here, it's a bit frustrating for me personally. I was in Denver at the Gold Show. I was standing on a podium, very, very confident that we were going to hit our commercial production targets by the end of September. But then in later September, we understood and realized we had to make some changes to the screen decks. We had to make some changes to the cyclone feed pumps. We had to make some changes to some of the feed chutes. And, a lot of these things, these aren't high dollar value, but they take some engineering, they take some lead time, and you've got to work through these issues to ramp up to that production rate. So we've been doing that, and we've seen, especially compared to sort of the beginning of October, we saw a lot of improvement on the back end of October through November, and by far the best couple of weeks we've had have been the last two, as we've just continued to move through some of these issues and increase that overall throughput through the mill. And I talked about this in our Q3 financials, just that Equinox really is at an inflection point in terms of both our production and our EBITDA, which is our earnings before interest, tax, depreciation, and amortization. And this would translate also into EBITDA as kind of a reference for cash flow from operations. So same thing with our cash flow from operations. What we've seen with the addition of Greenstone, the increasing production, the much lower cost, is a pretty radical jump in our EBITDA, sales, operating cash flow growth. Obviously, this was expected because we're building a brand new, large, lower cost mine. But Q3 was a quarter where Greenstone wasn't even in commercial production. We're just starting up. And still, we've seen the effect of, that lower cost, higher volume type of operation has a wonderful effect on our financial results in Q3. And, we're expecting to continue to see that kind of improvement through Q4 here and over the course of fiscal 2025. So I've talked about the mine today. There's a lot of potential at Greenstone. The district that we acquired really runs for about 100 kilometers west of the Greenstone mine. Regionally, there's a number of satellite targets, and I think there's a slide on those coming up. One of the biggest potential value drivers going forward at Greenstone is the underground that continues through this deposit. So the deposit basically in the east, it kind of daylights at a lake, and then it runs, on an angle down dip toward the west. And that, the shallow part is the open pit, and then as it goes deeper, you're going to end up with an underground mine. There was historic underground mining in the area, produced a lot of gold, 4 million ounces historically from the region. The westernmost drill hole in this underground deposit is over 20 meters at over 18 grams per ton. There's very high grades in this underground, has not been well drilled out in a number of years, but there is a decent resource in this underground at Greenstone. So over 1.5 million in indicated. We got another 2.4 million ounces in inferred. Because of the nature of the inferred resources, what we'll look to do over the next few years is do a scoping study on what's surfacing the value that underground ore would look like in the mine. So going underground, starting to mine, supplementing the open pit feed through the mill. And as we demonstrate those economics, eventually we'll put a drill program in place and start to drill out this underground deposit. But a fair bit of upside in terms of gold production from the underground is almost a certainty in the future here at Greenstone. And then as you look at this slide here, you can see Greenstone mine on the far right. Within that Kenogamisus property, we've got a number of regional targets. There's the Kaylee target, the Little Long Lake mine is in that area, and there's a number of these sort of regional open pit targets peripheral to the Greenstone mine. And then as you move your way west, we have what's called the Brookbank property. That's got another 680,000 ounces between a higher grade open pit and underground deposit. It's pretty close to our Beardmore property. The Beardmore property is a historic producer, 3 past producing mines, produced at over 1 million ounces at over 10 grams per ton. It's had no modern exploration. We still own a mill on that property. And so over time, this is not like a next year type of thing, but over time, we'll start to explore this overall district here. And, whether these are some of our properties for Equinox will depend on scale, but unquestionably, there's a tremendous amount of value, we believe, to surface over this entire district here. So moving beyond Greenstone, we do have a fairly large operating base in Brazil, currently made up of 4 mines. This is our Fazenda mine, Aurizona mine, Santa Luz, and the RDM mine. I'll start with Aurizona. Aurizona is in the state of Maranhão in Brazil, fairly far north in the country, not far from the coast. This is an open pit mine that we brought into production in 2019. On average, it's done about 110,000 ounces per year. This district that Aurizona sits on is extremely prospective. We're also going to go underground at Aurizona. I think I have a slide on that coming up, so I'll hold off until I get there. But a lot of potential at the Aurizona mine. 2024, a bit of a tough year at Aurizona because we had some movement in our south pit wall at our main pit, and that blew about 2 months of production out for us. We were able to get back into production through the development of our next open pit at Aurizona, the Tatajuba open pit, which we had planned on getting into anyway in the 4th quarter this year. We were able to accelerate that and get back into production at Aurizona. The main Piaba pit is where we had the issue in the pit wall. We've been working on a remediation for that. We'll end up back in Piaba in 2025. And so short-term speed bump there, but ultimately should not have a material effect on the long-term operation of the mine. And then moving quite a ways south into Minas Gerais, we have our RDM mine. This has been a kind of a smaller mine for us. Open pit, it's got an underground deposit. Whether that's something Equinox develops or not is to be determined. Annual production's averaged around 55,000 ounces per year. This mine's been great for us in 2024, cash flowing nicely, great team at this mine. Right now, they're focused on identifying opportunities for mine life extension. So this has been a good little mine for us. Definitely probably our smallest mine, maybe not as core as the rest of our portfolio, but nonetheless has been a good operation for us. And then the reason I want to group Fazenda and Santa Luz is because these mines are really within about 50 kilometers of each other, both in Bahia. They benefit from a land package that encompasses and joins both operations. So one of the things we're working on is amalgamating Fazenda and Santa Luz into what we call the Bahia district. There is an opportunity to take advantage of the economies of scale. So in terms of management, accounting, supply chain, purchasing, warehousing of materials, triaging results of exploration and new deposits between the 2 mines. And there's also tax benefits that come from amalgamating these projects into one project. So together, they're 140, 150,000 ounces of gold per year as one operating unit. And Fazenda in particular has got a lot of exploration potential in the existing deposit, which is about 5 kilometers of strike. We're working on a new open pit at Fazenda, a much larger open pit. And in 2025, we've increased our exploration budget at Fazenda to really drill out some more robust underground deposits within the existing underground mine. One of the challenges at Fazenda has been that, at this stage in the mine life, based on the exploration that we've been doing or that had been done in the past, you've got a number of working phases that are disparate in the underground. So the allocation of resources, of equipment, of people, and the hauls, et cetera, has just been really inefficient. What we're going to do at Fazenda is drill out some of the very high potential areas and start to concentrate mining in fewer places and just be able to mine more material at more efficient costs. And then Santa Luz, This mine is north of Fazenda. It's an open pit. It does have an underground deposit. Again, not something we're looking to develop in the near term. North of Santa Luz and south, but especially north of Santa Luz, there's a tremendous amount of exploration potential. We're working on that right now. This mill is kind of a unique mill. It's a resin and leach plant. It's one of the only plants like this in the Americas. Doesn't use carbon. It's a resin-based compound, and the reason is because there is a lot of organic material in the deposit, in the main deposit of Santa Luz, and it just doesn't recover in a traditional carbon and leach circuit. So, put in a resin and leach. Ultimately, our goal had been to achieve around 80% recoveries. We haven't gotten there yet. It's a fairly finicky process of recovery for this type of ore. When we get lower total organic carbon in the material, we get 80%, north of 80%. When we have high organic carbon in the material, it can plummet down to 50, 55. We're trying to manage somewhere around 70 at this stage, and right now we're achieving pretty much that level. But we are taking steps to increase that over the next couple of years through a couple of amendments or I guess augmentations to our plant, including a desliming circuit that will pull some of the more egregious organic materials out of the ore feed before it goes in for recovery. But collectively, together, the two mines, we should see a savings in cost, an increase in scale, and a more logical allocation, I guess, of capital into that project. And the Bahia complex itself will become a pretty major production center for us, similar to our Aurizona mine.
Greg, I'd like to ask a strategic question while you're on the Brazil slide. I'm having a debate with myself whether I should sell my West Dome and put the money into Equinox, because West Dome has 1.1 million ounces of reserves and it's $1.4 billion US, and you're 2.6. But you've got 15 or 20 times more reserves and resources. And I have a weaker debate with myself whether I should sell my Alamos Gold and put more money into Equinox. The market is penalizing Equinox for the $1,500 cash cost and $1,900 all-in sustaining cost before Greenstone arrives. Do you think you can turn around all four of the mines in Brazil and the mine in Mexico? Or would it be better to sell one of them because the market is over penalizing the cost variation? Some of your company is lower cost or just as good or better than Alamos or West Dome, but other parts aren't. The market seems to be kicking in the seat of the pants for the high cost mines and not rewarding you for the good mines.
Yeah, it's a challenging analysis. So I guess 2024 in particular, and I should say through 2021 we did see a pretty major inflationary effect on our mines in Brazil, actually across the company generally. That seems to have eased. The 2024. The denominator was the problem at Aurizona. Because we lost 2 months of production, you're incurring sort of a similar level of costs against less ounces, so you have a higher average cost per ounce that's manifesting there. Fazenda as well as a company or as a mine that in 2024 we saw an increase in the average cost per ounce as well, partly production, partly because they legitimately, just based on the mine plan, were incurring higher costs. What we're trying to do in Brazil is to a large extent simplify this. So Aurizona, get through the remediation of the open pit, get that back to sort of 120,000, 130,000 ounce a year producer, and then get the Bahia complex up there as well, 140, 150,000 ounce producer. Then you've got two nice chunky assets in Brazil, and you can kind of rationalize overall your cost structure there. RDM is a smaller mine, and in discussing any potential mine sales, I can say like right up until probably 2024, it was just not a good market to try to sell mines. And if we're going to sell a mine, ideally we're getting cash for it. We can use that cash to deleverage. In the case of RDM, we've had people express interest, certainly. What they've proposed has not really been that attractive given the cash flow we can earn from the mine in operating it. So, I understand, the market does not love high costs. We're working hard to reduce the costs, and I can talk a little bit about our asset optimization program later on. But yeah, it's always a challenge. I think personally, and we could talk about this later in the presentation, as we get Greenstone up and running, we get the amalgamation of Fazenda Santa Luz complete. Now you've got Greenstone, Bahia Complex, Arizona as three large, kind of easy to understand production centers. Los Filos we'll discuss when I get to the Los Filos side. It's a giant mine, great deposit, a little more complex, and it's going to be complex at least into the first quarter of next year. And then you have RDM, you have Mesquite as smaller operations, maybe non-core, and then Castle Mountain as your major development project. So you kind of simplify the operating structure of the company, and in the meantime, you're taking cash flow and in terms of capital allocation, you're deleveraging, and to some extent starting to invest in the expansion and the growth of some of these mines that have been, I would say, underinvested over the last couple of years as we've been building Greenstone. Again, a capital allocation decision that we had to make in the context of getting Greenstone up and running. Would Greenstone on its own deliver a higher multiple than the rest of the portfolio? Probably. It's a big mine in Canada, and there's a lot of value there. And so, to your point, you don't want to hold on to things that will, to too large of extent, drag down, the multiple overall, such that you're losing value on Greenstone. Of course, that's not something we want to see happen. So it is something we think about, John. And we've always been, I would say, commercial with our portfolio. We have sold a number of projects over the years, including 2 operating mines, a facility in Peru. We spun out a copper company. We created a royalty company. So we've been pretty good about surfacing value from our non-core assets over time. Frankly, the period of time here from sort of late 2020 through 2021 and 2022 just wasn't a very good market to try to surface value as aggressively as perhaps we had in the past. But let's dig into a couple of these, and then when we get to the valuation discussion, we can talk a little bit more about future strategy here. So, Arizona, I mentioned the underground deposit here. The interesting thing about this mine, you have a very comprehensive, robust, and discrete ore body running, sort of 5 kilometers along this pit in a nice sheet, sort of steeply dipping underground. It lends itself very well to underground mining. We've got the permits in place for up to 3 portals. Our plan right now is in 2025 to probably in Q2 or sometime in Q2 start the development of the first portal and the decline to go underground. Our plan is to get our hands on that ore body underground, do some bulk mining, some bulk sampling, potentially some underground drilling to better define the deposit, get an understanding of the ground conditions and ore body, and then continue to organically expand that underground. Really, the effect will be if we can get the production up, 1,000 tons a day, 2,000 tons per day, even 3,000 tons per day, it will supplant some of the lower grade open pit feed. So you get a higher grade average feed coming from underground, which just increases the overall average feed grade. And I look at, there's other mines in Brazil, certainly that are underground. The one that I kind of look at as an example as to what could be possible here is Pan American's Jacobina mine. For a lot of years, it was a lower ounce producing mine. They've got about 15 kilometers of strike. I think they have 8 mines across that strike. And over time, they've just built up enough operating faces there that they can really efficiently mine a lot of tons underground. Sub 2 grams is the average grade. And yet that mine will produce 200,000 ounces plus per year. and is one of the highest cash flow producers for Pan American Silver. So, it's going to take a while to get Aurizona to that level, but I think it's a good demonstration of what can be possible when you've got an ore body like the underground ore body we have at Aurizona. So more on that in 2025 as we break ground on the portal and get our first look at that deposit underground itself. And then regionally at Aurizona, huge property. Piaba is the main pit that I was talking about. The Piaba underground is the bit that we're going to go underground on in 2025. Tatajuba, we're mining now. The little red outline there is the initial deposit. We call that the peanut, but we've drilled out an extension both east and west from there. So Tatajuba will continue to expand through the rest of this year and through 2026. And then to the east of Piaba, we've got some satellite deposits. They're not big, but that type of material, very, very soft, saprolite material at surface, pretty good grades. It goes through the mill like stink. It's great feed for the mill. Very easy to process, very low cost. So those will come into the mine plan as well. And then to the north of Piaba, we call it the Piaba North Trend. This is part of our mining license. It's undrilled. We've been working on land agreements in that area. The reality is that when you stand on the north waste dump at Piaba and look at that Piaba North Trend, there's been artisanal mining for kilometers along that trend. And then, they're pulling fairly large nuggets of gold right at surface along Piaba North, along that Piaba North Trend. Bottom line is very, very prospective area near mine at Aurizona. It's an area we'd like to get drilling as well next year if we can. And then regionally, huge land package. We've got multiple deposits in the land package, some of them more advanced than others, but certainly there could be multiple mines within our overall land package at Aurizona. And with Greenstone now built, this is an area where we can start turning our attention to, again, trying to surface value from some of these assets that are kind of buried in our portfolio, including this district scale land package that we have near Aurizona. And then moving to Mexico and the United States, I mentioned Los Filos is a more challenging mine to talk about. The reason is huge mine in Mexico, Guerrero State. Again, big deposit, permitted, produces a fair amount of gold right now. The mine itself it's been going since 2008. The pits are getting deeper. The new underground mines that will be in development are higher grade than has been mined here in the last number of years, and they also have certain characteristics that does not lend itself well to continue heap leaching. And this is a big, heap leach operation. Some run a mine, some crushed. So the future of the mine requires us to build a carbon and leach plant. And, that's a meaningful investment. You're talking $300 to $400 million. It would increase production at Los Filos to around 280,000 ounces per year. So it's a great project for us. But the project currently has agreements with 3 local communities, both land access and social agreements, and the term and the cost burden and the operating requirements pursuant to those agreements do not lend themselves to a positive investment decision to build that CIL plant. And so what we're doing right now is working with the communities and the government to renegotiate these deals. They have to be renewed anyway, so this is not a totally unplanned thing, but renegotiating these deals to create an investment environment that will lend itself for us to build out this expansion at Los Filos. And if you go back a couple of years, this is all public. We first bought Los Filos. COVID hit immediately, so we had to close the mine down. Every mine in Mexico closed for a period of time. When we brought the mine back up and running that summer, very shortly after that, it ended up getting blockaded by one of the communities. And so we effectively lost most of fiscal 2020 to either COVID or this blockade. And as a result, when we went into production in 2021, we had lost a year. The cost structure of the mine was higher than we had anticipated, and we had always intended on building a mill there, but it became clear that when we had an option to, at this point, we had bought Greenstone. So you're looking at allocating capital to Greenstone, you're allocating capital to Los Filos. It became clear that we would allocate preferentially to Greenstone, and that Los Filos needed a lot of work before we could get that to an investment decision. So this year, it's on track to produce over 170,000 ounces of gold in 2024. It's one of the best years we've had at Los Filos, but it's high cost, and in part it's because you're incurring a lot of costs to get that mine on the heap leach, but you don't get very good recovery. And you've got, as the copper content in the ore goes up, you end up spending more on cyanide. We have a number of operating commitments in pursuant to those agreements that also have an effect on the cost structure. So it really needs a rework in Mexico. We're really working hard at that right now. If we're able to accomplish something there, then then Los Filos has a wonderful future, and we can make the investment, and over time we'll build out the expansion. And if we can't get to an agreement there, it's entirely possible we would suspend operations at Los Filos. So it's a bit of a tough one right now. It's a bit binary. I think between today and the end of the first quarter, we'll come to some kind of conclusion there. And again, everybody in the communities, the government, and us, we all want to see this mine continue to operate. So we're working hard to get to agreements that work for everybody. That's happening in real time. But to your point, John, Los Filos has been a very complicated mine for the market to digest. It's producing a lot of gold this year, but it's fairly high cost. And there's a lot of uncertainty as to whether or not it continues on this path or not. And so that definitely is having an effect, I think, on market perception of the company, which translates into our share price. And the reality is we've just got to keep mucking through it and get to a resolution on it to get that clarity for the market. And as I said, I'm hoping that is something that we've completed by the end of the first quarter next year. United States, we've got the Mesquite mine in California, and Castle Mountain, which is about a 3-hour drive from Mesquite, also in California. People have a lot of opinions on operating in California. I can tell you from our perspective, it's been fantastic. We're the biggest gold producer in California, and probably the biggest mining company operating in California. And we've been able to work very well with both the counties and the state and the federal BLM in terms of getting our permits and operating these mines and expanding them. Yeah, Mesquite's been going for, since 1986. It's produced over 5 million ounces of gold. It's a very simple operation, just a open pit run of mine heap leach operation. This year it'll be in kind of that 65 to 75,000 ounces. Next year it'll be a higher production rate. It's a fairly mature mine, so what happens at this stage in the mine life is we end up doing a large stripping program, and then once we get into the ore, we're stacking a bunch of ore. So you have a period of time where you're not stacking much ore, all of your production's from residual leaching, then all of a sudden you're into ore, you stack a bunch of ore, you get under leaching, you get a plume of production. So it's a little inconsistent. We bought it with 3 years of mine life back in 2018. We're still operating it today, and we continue to have 2 years of mine life ahead of it. We just keep expanding the mine. And then Castle Mountain, this is a project that we acquired back in 2017. It had been a prior producer that had been largely reclaimed. We completed a feasibility study that outlined almost 220,000 ounces of gold per year over an initial 11-year mine life. And what we did is we put phase 1 into production under the existing permits, which allowed us to excavate the historic pits and get a gold credit for doing so, because what was waste back in the 1990s at today's gold price and with today's technology became ore. And we've done that. We ran that for a number of years. And in 2024, we decided to suspend the phase 1 operation. Again, all we were doing is processing waste from the open pits. We had pretty much excavated most of what we had planned to under our initial expectations for phase 1. We also had a fairly meaningful advancement in the permitting for phase 2. And so now Castle Mountain will be strictly a development project. We expect to have what's called the notice of intent from the BLM sometime in the first quarter of 2025. That would put us on a time frame to get the final permit sometime in 2026. I'm going to say late 2026, and then we'll be in a position to make a construction decision one way or the other to expand Castle Mountain to that 200,000 ounces of gold per year. In the meantime, what we'd like to do at Castle, and which we will do at Castle, is we're going to advance the detailed engineering. And so when we finally get to a construction decision based on receiving the permits, we want to be very similar to Greenstone, where we've got the majority of the detailed engineering complete, very high confidence in what we're going to build. And at that point, we've done all the planning necessary to execute a very successful build. So that's the plan at Castle Mountain. In terms of near-term catalysts, I think the next big news there will be receiving the notice of intent. And then from there, it's a pretty systematic process to get the final permits in place. And when you look at all those, Greenstone aside, it's producing now. When you look at the addition of the underground mine at Arizona, bringing Castle Mountain on, and then the expansion of Los Filos, there's organic growth there of 420,000 ounces of gold per year from our existing portfolio. We've been saying this for a while. I don't think we've quite seen it the way we expected to, but we expect that over time, as we increase our production, as we reduce our cost base, as we increase cash flow, we reduce the execution risk with Greenstone coming online. It's in a top mining jurisdiction. It's got the long reserve life, that eventually we should start to revalue in terms of our multiple toward at least an intermediate producer and ideally toward a senior producer. Again, I think as Greenstone ramps up, as we demonstrate deleveraging of our balance sheet and we get clarity on Los Filos, I think we should start to see that revaluation happen in the market. And you can see, we're trading pretty low. John made this point earlier in the call. On a price to NAV basis, we're kind of down at the bottom, 0.6 times NAV, and yet we're sitting on total reserves near the very high end of our peer group. Our production, this is on a consensus basis, also near the high end of our peer group, and our growth is also near the high end of our peer group. So, we've got a lot going for us compared to the peer group generally. We're trading at a much lower multiple. That's the gap that we're trying to bridge. At the end of the third quarter, we were sitting on cash of just under 170 million. We had another 100 million plus available under our revolving credit facility, plus another 100 million accordion feature. Our mines are cash flowing. We were cash flow positive in Q3. We'll be cash flow positive Q4. Debt, we've got a fair bit of debt, about $1 billion of drawn debt plus convertible notes. Subsequent to the quarter end, 140 million of those convertible notes converted in the money. And so that has reduced now fairly meaningfully. And then on the drawn debt, the majority of that is, about half and half. Our revolving credit facility with a syndicate of banks, and then a term loan that we took out to buy the rest of Greenstone. Ultimately, in 2025, we'll probably look at terming out the term loan, which is $500 million, and extending that maturity of that instrument, negotiating our revolver and terming that out as well, but then also paying down our revolver as aggressively as we can. And then ideally we'll either convert or pay down another 140 million of convertible notes in 2025. So a real focus on deleveraging. Again, every dollar that we put on our revolver, we're saving 9 cents plus in interest per year. And so as you pay down your debt, you're reducing your interest cost, freeing up more cash flow to pay down debt. And you can get a pretty meaningful deleveraging happening fairly quickly over the next couple of years. And this is just an example, really, our net debt to EBITDA. And you can see that as we've built mines, we've increased our leverage ratios. As we've brought them into production, we've decreased our leverage ratios. And what we're anticipating is sort of through the end of 2024, we'll see a decrease in our leverage ratio, and it'll meaningfully decrease through 2025 and 2026 as we increase our earnings, our EBITDA. At the same time, we start paying down debt. So we should see this leverage ratio continue to decrease pretty aggressively here over the coming quarters. Talked about an inflection point before. Right now, we're in a wonderful period of increasing production with decreasing costs. We also have a much larger proportion of our production coming from one of the best mining jurisdictions in the world, which is Ontario, Canada. And so both of those aspects, we think, should be a nice catalyst for the share price going forward.
So going back to the slide that you just left, you're projecting that the all-in sustaining cost drops from 1,900 in the year just ended to 1,525 and about 1,400 in round numbers in 26. How much of that is Greenstone alone? All of it?
So to be very clear, these are analyst estimates, and so this is consensus analyst estimates. This is not a projection from us, but a large chunk of that, especially in 2025, in particular, you're seeing the effect of Greenstone, especially, and then we also have decreasing costs associated with the Brazilian portfolio for sure, as we increase production at Aurizona and also between Santa Luz and Fazenda.
It would seem like if you get Mexico right and you don't have the technical problems like pit wall slides and bad recovery in Brazil, that your costs could fall even more than that.
Well, yeah, I mean, 2024 was a challenging year, no question. And you can see it reflected in the costs because 2022, 2023 are actuals, 2024 is estimated. And we did have a big bump in 2024, in large part because of a denominator. You know, we did produce more gold, but that's also the effect of Greenstone, right? At some of our other mines, we didn't. Mexico, we actually produced most gold we've ever produced there since we've owned it, but the cost structure is still too high, and that's going to be very hard to manage. A whole lot lower in absence of new agreements or the building of a CIP plant, which in part is why, if we can't get those new agreements, we're not going to build that plant, and we're going to suspend the operation because we don't need to continue, have no desire to continue at a cost structure that makes no sense. So, the consolidated gold production here that they're predicting, the analysts are predicting, would include Los Filos. I don't know exactly what costs they're predicting here. If you were to extract Los Filos at their current cost base, you'd have lower production, but you'd also have much lower costs because Los Filos right now is such a high proportion of production at a much higher cost base. So I think this is the last slide in the main deck here. So again, Equinox Gold, I got the points here. The gold price has been strong. It seems like it's continuing to want to rise. We'll see what happens here as we go into 2025. Today was certainly a good day. Near-term low-cost production growth from world-class mine. Well, that's happening now. I mean, we're ramping up Greenstone in real time, and so that is happening and will continue to happen through 2025. We have increased our cash flow. Operating costs are coming down. The big news here is really that we successfully completed the construction of Greenstone. We successfully got it into commercial production. Now we're in the point of ramping it up to its full capacity. We've got a lot of value we can surface from that region around Greenstone. And these mines are incredibly rare. Some of our peer group that are also building or have started production at large mines in Canada have seen pretty meaningful re-rates in their stock. We haven't seen that yet, and I think in part due to some of the reasons we talked about in the presentation. As we work through those issues, demonstrate Greenstone operating where it should be, demonstrate reduction in leverage, come to some kind of clarity on Los Filos, I think we'll see the Equinox shares start to perform a lot better as well. So that's where we are today, John. I appreciate the opportunity to present to you guys. I've been talking straight for an hour here. So I'll open it up if you'd like to for the questions.
We appreciate everyone's patience on the call. Please submit your questions in the question box. From Rich Howard at Boiling Point Capital. Based on your experience ramping up Greenstone, what process, plant, and facilities redundancies do you plan to engineer or introduce in the next 18 months? talk about your debottlenecking and improvements and learnings.
Yeah, I would say, I mean, there's, we've got a running list of things, and the way we framed it to the operators was assume there's no restriction on resource or capital allocation. What would you do to really make this thing hum? And we've kind of taken that list and we've taken the highest value items and we're starting to work through those. And two of them that are fairly easy, but also have an outsized effect, are increasing the inventory of both crushed ore and fine ore within the circuit. And I'll explain that in a little more detail. We've got a primary crusher, secondary crusher that feeds into an ore dome, right? There was a picture I had there on the slide of that big white dome. That dome holds, call it 16 hours of production, but not all of that is live. So it's actually less than that that's sort of live feed. So if the crusher goes down, you've got the ability to continue feeding your HPGR and your mills from that ore dome stockpile. In some cases, we've had situations where we're doing a fairly major repair of or change out of equipment on the crushers, and we run down the live feed in that dome. And it's a bit of a pain right now to move material around such that you can keep the feed, the non-live feed, make it live. So what we're going to do, and I think this is pretty similar to something Cote is doing, and which leads me to wonder why we didn't engineer this in the first place. But the reality is, what we're finding is if the crushers go down for too long, we have to shut down the whole thing because we don't have enough ore feed. So having the other side of that is the crushers can crush way more material than the mills can process. So it's no problem for us to crush and have a nice big robust stockpile ahead of the mills. So the plan here now is to engineer an exterior crushed ore stockpile, throw some hoppers and conveyors so that it can work well with the feed in the dome, and that'll reduce the reliance on maintaining throughput when the crusher is down. The other very similar issue we have is between the HPGR and the ball mills. And between those two pieces of equipment, we do have what's called a fine ore bin. It only holds, I don't even think it's a few hours of material. It's not big at all. Same issue there is if you have any maintenance that you need to do on the HPGR, your HPGR is down, you can't feed your mills because you don't have enough material in that bin. So anytime the HPGR is down, the mills are down. Anytime the mills are down, the HPGR is down. By building a larger fine ore stockpile, we can manage that much better. It means if the HPGR goes down for major maintenance, we don't have to take the mills down. We've got, a day or however long of operating through the fine ore stockpile bin. That one's a little more complicated because to do it, we're going to have to fabricate something that sits on the outside of the building. But again, it's an area that for not a lot of money, pretty minor engineering, you can increase the resiliency of the plant quite a bit. Because what we're fighting, and what we've been fighting as we've ramped up, is overall plant availability. And if things aren't perfectly timed in terms of maintenance, if you have anything unexpected and it lasts for too long, it can throw a wrench into the whole thing in terms of maintaining throughput. So by increasing resiliency between the crushers and the HPGR, and between the HPGR and the mill, we have a lot more flexibility as to when and how long we do maintenance on each component. Even if the mills go down and we keep running the crushers into the bigger stockpile, we can keep running the HPGR into a much larger fine ore bin. So that's an area that we're working on. There are some things that's going to be a nice to have, and I think will make a difference. There are some things that are must have, and we've been working our way through those. The stream decks we've largely resolved. The cyclone feed pumps, we're installing a different vendor, a new one as we speak, and we're going to test that one out, and ultimately we'll come to a conclusion on what works best there. But we have experienced a lot of downtime due to premature wear in our cyclone feed pumps. And then within the CIP circuit, we have what are called these plug valves, and they mitigate or manage solution flow between tanks and also between tanks and the tailings outflow piping. And what we've had an issue with sealing of these valves, and we're losing solution to tailings. And there's like gold in solution, so not a good situation. Reduces your overall recovery. We've got series 14 of these valves being delivered in January. They go from being like a hockey puck valve to a hard plug valve that actually plugs the opening. And I think once we make that replacement of those valves, we'll also see a decrease in any solution losses that are pregnant solution losses, and that should increase the overall recovery. That's a must do. So there's a bunch of these technical must do's, and then the bigger kind of increasing the resilience of the overall plant, in part that'll be through inventory. And there's always the argument that there's a trade-off, right? Because if you have more inventory, you're parking more capital on your balance sheet, and wouldn't that be better converted to cash flow? In my entire career of mining, you can optimize the hell out of these things, and that's fine. But mining's a little more complicated than manufacturing, and I think it does make sense to build in enough resiliency in the circuit to maintain your production level. So small cost, but I think the benefit's worth it.
Greg, you described some restructurings in companies that Equinox has bought or sold. Is Versamet the only company you continue to own securities in, or are there others?
Versamet is the largest company we own securities in. It's still private, but it's about a probably $250 to $300 million US implied market cap company. We own around 12 or 13% of that now in partnership with B2 Gold, Sandstorm Gold, and Regal Funds out of Australia. And we also own equity interests in Bear Creek Mining. We own equity interests in a couple of other small private companies as well, and not much, but some. The next main one would be Bear Creek. I think I want to say we're around 17% of Bear Creek at this stage.
Your plan for next year is to repay debt, and none of us like to have debt. We're all rooting for that. Maybe again in 2026, but you've got the Castle Mountain construction whenever the permit comes, the mill at Los Filos if the things can get settled, and then the underground at Arizona, Los Filos, later down the road, Greenstone. So you've got 5 significant great opportunities you're looking at. But Ross has founded at least 10 companies I can think of. Lumina Gold in Ecuador is going to move from exploration and permitting to construction. Pan Am Silver has a $2.8 billion capital project that's too big for Equinox or them maybe. Then you're on the board of I-80 Gold, which Equinox used to own 24.7% of, and poor Richard Young did his maiden conference call and announced the recapitalization, and the stock went down 60% and recovered. They probably could have financial help. You could buy your 25% back for 2/3 less or more now if you wanted to. How do you manage the trade-off of all the opportunities that could come through the door from people that are like your best friends that you know already?
I mean, the way we look at it here is, and you're right. I mean, there's always opportunities. There's always things to invest in. There's always ideas we toss around and what would be really cool to do. At the end of the day, the best possible money you can spend usually is on your existing asset base because you already own them. And usually it's in generating either exploration dollars. This is one of the best returns of capital in our industry. Is what makes our industry so attractive is you can do a $5 million drill program at a mine that has a relatively short life and generate $100 million of incremental NAV because you've added a year or 2 years of production that's only 4 or 5 years out. And so, or you find a new ore body that comes into the mine life sooner, or whatever the case is. So when we're sitting here looking at where we want to allocate capital, if we've got something we can build internally that we already own, and we can run an IRR model on that and say, okay, well, like we're going to invest here. I mean, debt right now, I get 10% almost, 9% cash on cash return by paying off debt. It's a very good use of capital internally. But if I can drill out another year at Mesquite, or I can drill out 2 more years at Fazenda, and I can add those into my mine life, that's a really meaningful return on invested capital in terms of the NPV of those projects and maintaining those mine lives. So that's always going to be kind of a focus for us. You know, when you look at our portfolio, we do have good internal opportunities. We've got a good development project in Castle Mountain. We, you know, regionally, excluding regional opportunities to our existing mines, we don't have a lot of, you know, longer dated projects that you can work through exploration into development and kind of have a pipeline of your next builds. Castle's there. There's not much beyond it other than the organic growth in our project. So, you know, if we're talking about opportunities that Equinox might have some interest in, you know, it might be some of those earlier stage opportunities that are trading at a big discount to where producers are trading. To some extent, we haven't seen opportunities that really get our juices flowing, so to speak, right, in terms of the valuation and what it could add to the company. So, you know, I'm rambling, but I guess in short, we're always thinking about trying to frame things in terms of capital allocation, what makes the most sense, right, strategically, and then in terms of you know, you've got what it's going to take just to keep your minds going, and then it's also what can we do that's going to create outside value for the expense. And then when we look at debt reduction, you know, you're getting let's just say you're getting your 9% cash on cash return. That's great. To your point, John, a lot of our shareholders want to see us reduce that debt. I think it does weigh on our multiple. And so by paying down debt, we can then start to hopefully see that manifest in a better multiple for the company and see it reflected in the share price.
Once again, anyone who wants to submit a question in the question box, last call. Greg, we appreciate your comments. Thank you for your service to the shareholders and the entire team. I know there's a lot of work that's gone into the company that's not reflected in the stock price, but that'll take care of itself as you cut debt and cut costs.
All right, John, thanks for having us. We really appreciate it, and thanks for the support.
Thank you. Happy holidays, and have a good night.
You too.
Thank you.